Federal Reserve has cut interest rates for the first time since December, lowering its benchmark lending rate by a quarter point to a range of 4 to 4.25%. It's the first rate cut of President Trump's second term, and Fed Chair Jerome Powell says the decision is about managing risks in an economy facing slowing job growth and the unknown impact of tariffs.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. While the unemployment rate remains low, it has edged up. Job gains have slowed, and downside risks to employment have risen.
The U.S. Central Bank projects 2 more quarter-point cuts before the year is out. But Powell admits the path forward isn't obvious.
Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen.
Behind the cut lies a mixed picture. Inflation in some tariff-hit goods like furniture and appliances, but also signs of businesses swallowing higher costs.
What seems to be happening is that the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is it's very clear that there's some pass-through.
That tension, tariffs nudging up prices, but weak hiring threatening jobs, has left the Fed trying to balance both sides of its mandate. Powell points to a cooling labor market shaped not only by trade policy, but by slowing immigration and weaker hiring.
Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation.
The Fed's move wasn't unanimous. Newly sworn-in Governor Stephen Miron, still on leave from the White House, wanted a bigger half-point cut, underscoring questions about Fed independence.
How can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Even as the Fed trims rates, it's also shrinking its own balance sheet and staff.
We're actually going through a 10% headcount reduction through the whole Fed, including the board and all the reserve banks. The employment at the Fed at the end of that will be basically at the same level it was more than 10 years ago.
For households, the immediate effect of Wednesday's cut may be modest, but with tariffs still filtering through supply chains and unemployment edging up, the Fed is signaling it won't wait for the economy's future to become crystal clear. Instead, officials say they'll move meeting by meeting, trying to ensure a temporary price shock from tariffs doesn't turn into a lasting inflation problem, while keeping America's job market from slipping further. Bureau Report, Business Today TV.
If you like the video, do like, comment, share and subscribe.